OpenAI just raised $122 billion at an $852 billion valuation, making it worth more than Coca-Cola, Nike, and McDonald's combined. There is just one problem. The company has never made a single dollar of profit. In December 2015, OpenAI emerged from Silicon Valley as a nonprofit research lab founded by a circle of tech insiders with a single, ambitious goal: make artificial intelligence benefit everyone, not just the few who could afford to build it. Sam Altman, already known for his leadership at Y Combinator, stepped in as CEO. The early days were marked by open source releases and a sense of mission-driven optimism. But as the potential of artificial intelligence and its costs grew, so did the pressure to secure resources on a scale few could imagine. By 2026, OpenAI's transformation was complete. The company closed a $122 billion funding round, pushing its private valuation to a staggering $852 billion. This figure eclipsed household names like Coca-Cola and Nike, all while OpenAI remained unprofitable. The valuation was not set by public markets, but by the price investors agreed to pay for preferred stock, shares with special privileges like liquidation preferences and board observer seats. Microsoft, OpenAI's largest investor and exclusive cloud provider, had already poured in over $13 billion, and the latest round drew in new giants: Amazon, NVIDIA, D.E. Shaw, SoftBank, and Andreessen Horowitz. Valuing a private company at this scale is less science, more negotiation. The headline number comes from multiplying the price per share set by the latest deal by the total number of shares. Unlike public stocks, where millions of trades set a real-time price, private valuations hinge on what a handful of investors are willing to pay. Illiquidity premiums, secondary transactions, and preferred stock perks all factor in, making the math more artful than precise. For investors, the appeal is scale and first-mover advantage. ChatGPT claims 500 million weekly users. OpenAI's APIs process billions of queries daily. The bet is that whoever leads in AI will shape the next era of computing. Yet OpenAI's financials remain daunting. Despite surging revenues, the company burns through billions each year, much of it spent on compute powered by Microsoft's cloud. Profitability is still a distant prospect. The $852 billion valuation is built on a mix of ambition, belief in future dominance, and fear of missing out. As rivals like Google, Anthropic, Meta, and open-source challengers close in, the risks only grow. Whether OpenAI's lead will hold and justify its price tag remains an open question. Running an AI company at OpenAI's scale means living with costs that dwarf even the wildest startup burn rates. Every day, billions of queries flow through the company's servers. Each one triggers a cascade of GPU cycles, electricity bills, and data center overhead. The financial math behind this is both simple and relentless. The more people use ChatGPT, the more money OpenAI loses. Costs break down into two main buckets. First, there is training. Building a model like GPT-5 or its successors means harnessing tens of thousands of top-tier GPUs for weeks or months at a time. These training runs are not a one-off expense. They repeat with every major upgrade, every new generation. Analysts estimate that OpenAI spends between $3 and $4 billion a year just to train and retrain its largest models. These are fixed costs, paid up front, and they do not shrink as the company grows. But the real cash drain comes from inference, the process of running the model every time someone types a prompt or makes an API call. Inference is a variable cost. scaling directly with user demand. With hundreds of millions of users and billions of daily queries, the numbers add up fast. In 2026, OpenAI's inference compute bill alone reached $10 to $11 billion. That is about 60% of the company's total cash burn. Each API call, on average, costs more to serve than it brings in revenue. Microsoft's internal data put the cost at $2 of compute for every dollar of API revenue before even factoring in salaries or infrastructure. The rest of the expense sheet is no less daunting. R&D and ongoing model development require another $3 to $4 billion a year. Headcount and sales, with engineers commanding $500,000 salaries or more, add another $2 to $2.5 billion. Data center buildouts and cloud contracts, mostly with Microsoft and CoreWeave, soak up at least $1 to $1.5 billion annually. The total is $17 billion in annual burn, outpacing even OpenAI's revenue surge. For every free tier chat, OpenAI loses money. Even paid users and enterprise contracts, though better, often run on thin margins once all costs are tallied. The company's own projections show that profitability is years away, with break-even not expected until 2029 or 2030. The underlying tension is clear: scale brings dominance, but also accelerates the cash outflow. The more successful OpenAI becomes in terms of usage, the more acute its financial challenge. Investors are not just buying into a user base or a product. They are underwriting a business model where every new user increases the short-term losses. The hope is that eventually efficiency gains, price hikes, and enterprise deals will flip the unit economics. Until then, the operational math is unforgiving. For now, OpenAI's engineering and finance teams are locked in a race against the clock, betting that the world's biggest AI bill will someday pay itself off. Three pillars hold up the $852 billion bet on OpenAI, each more ambitious than the last. The first is scale. ChatGPT draws in around 500 million weekly active users, a figure that rivals the largest platforms in tech history. Every query, every conversation feeds a network effect that is hard to replicate. For institutional investors, this is not just a number, it is a moat. The thinking goes, once you reach this level of engagement, switching costs rise, habits form, and competitors face a wall of inertia. The second pillar is enterprise. OpenAI's APIs and business contracts now stretch across industries, from finance to healthcare to software development. Companies pay not just for access, but for the promise of integrating AI into their workflows at scale. Microsoft, the largest investor, has embedded OpenAI's models deep into Azure and Office, while other giants such as Amazon, NVIDIA, and Oracle are locked in as both customers and backers. These enterprise deals offer recurring revenue, higher margins, and the kind of platform lock in that can outlast consumer fads. The third pillar is the wild card, optionality, the possibility of artificial general intelligence. Investors are not just buying into today's products or even next year's revenue, they are buying a lottery ticket on that possibility. The upside, if OpenAI gets there first, is almost impossible to model. In this narrative, losses today are the price of owning a stake in the company that could define the next era of computing. Each pillar has its own logic, but together they create a story that can justify almost any price, at least on paper. OpenAI's position at the top of the AI world is anything but secure. The company faces a gauntlet of threats that could unravel its $852 billion valuation in ways few investors want to admit. On one flank, Competition is relentless. Google's Gemini, Anthropic's Claude, Meta's open-source Llama models, and a surge of startups all target the same users and enterprise contracts. These rivals are not just catching up, they are luring away OpenAI's own talent. Over the past 2 years, at least 20% of OpenAI's senior researchers and engineers have departed, many for Anthropic or to launch new ventures. Some cite frustration with the shift from mission-driven research to aggressive commercial expansion. Others point to the breakdown in governance that followed the boardroom crisis of 2023 and the ongoing legal battle with Elon Musk, whose lawsuit accuses OpenAI of betraying its founding principles and ceding control to Microsoft. Legal uncertainty clouds the company's future. If Elon Musk prevails, OpenAI could be forced to unwind its for-profit structure, jeopardizing investor returns and Microsoft's integration deals. Even without a courtroom loss, the lawsuit has already cost tens of millions in legal fees and distracted leadership at a critical moment. Meanwhile, regulatory scrutiny is mounting in the US and Europe, with lawmakers questioning the safety and transparency of frontier AI models. Any adverse ruling could freeze product launches or force costly compliance changes. Against this backdrop, the next 3 years could fork in two starkly different directions. In one scenario, OpenAI fends off legal and regulatory threats, retains enough top talent to keep advancing its models, and leverages Microsoft's backing to dominate enterprise AI. Margins improve as compute costs fall and more users convert to paid plans. The company edges toward profitability, and the $852 billion bet starts to look prescient. In the other scenario, rivals chip away at market share, the best researchers continue to leave, and the legal battle with Elon Musk triggers governance upheaval. OpenAI loses its edge, margins erode, and the dream of AGI-fueled dominance slips further out of reach. For users and investors alike, the future remains unsettled, a high-stakes wager with no guarantees. Subscribe to the Signal Layer for weekly AI and tech breakdowns that go deeper than the headlines. Today, OpenAI stands at a crossroads, $852 billion on paper, and yet it is burning billions in pursuit of dominance. Investors are betting on the promise of AGI, not proven profit. In this race, belief often overshadows reality. For more stories beyond the headlines, subscribe to the Signal Layer.